Hey everybody, welcome to Financial Revelations. I am David Szafranski, your host, your weekly host of this podcast, which I hope you find valuable and informative. You can reach us at 1-800-344-2534 every Thursday morning, except for this past Thursday morning. I am on WCRF 103.3 in Cleveland, and you can always find us on the app. Moody Radio's app. It's on, I have Apple products, so it's on their app store, but any place that has apps, you can find it. And, you know, I know this is all scrolling down here, but Corey at epsf.com if you have questions, which we have a few today. So I wanted to go over a little bit of economic data that came out this week because it is a little bit more promising. It's not great. I want to warn you, there is no great news right now. The markets are up this week. It looks like they're going to close down today. They kind of had a lot of just momentum coming into this morning, and I think it's draining a little bit because we're getting closer to a Fed meeting at the end of the month, which we're going to talk about. But inflation numbers came in this week, CPI and PPI, and it's true. Inflation is lower than it was last year at its peak of 9%, but it's still way too high. And when you break out things in the inflation report, like school supplies, those are up 21% year over year. And one of the reasons why CPI is low is because the price of gas has come down, and so it's going to reflect in the CPI. But there's a lot of things like food and electricity that are very expensive, and that's not changing. And so, yes, year over year, or at least in this number, the numbers looked more promising, but they're a little bit deceiving in that we need negative numbers. Year over year, it's still way too high. Wages are too high. And I know this sounds odd. Well, people are making too much money. Could that be true? No, that's not really true. But I want you to let me just postulate a little bit here and expound. If you had you see this almost all the time, well, at least from time to time, you'll see somebody on the news. It'll be somebody working at a fast food place, and they're a little bit older, and maybe they got 5 kids, and they say things like, I work 50 hours a week here, and I can't support a family of 5 on this fast food restaurant. Yes, that's correct, because really, it's a teenager's job. That job was never meant to support a family of 5 on. It was not really meant as a career position to work the drive-thru window. Now, for some people it is. There's nothing wrong with that. I don't want to disparage anybody for working. That's a great thing. And, I remember when I joined the Army, people said, well, why would you want to do that? And I said, well, I got to pay for college. And you know what? It's a great thing. It teaches you a lot. And so just, if you're going to work someplace, just, do something, even if it is there for a time. That's okay. Don't be ashamed. It's a good thing. But you're not going to support a family of 5 on it. And so you'll see this on the news, and they'll say, well, it's just not right that they can't support a family of 5. But it was really just a teenager's job the whole time. So you get a 16-year-old working at the drive-thru window, they can't be making $25 an hour. It's too expensive. It's really a minimum wage job, and that's where it should be. But so those wages have to come down, and those wages are still high. And rents in the CPI, rents are still high, and housing has yet to be crushed. So rates came down a little bit this week, and the 30-year mortgage dropped to just under 7%. When you think about where it was 2 years ago at 2 3/4, that's a big change. It's a rapid change. It's a order of magnitude change. It's not just a little bit. It's a lot. Housing has yet to be crushed. So what happens at the next Fed meeting? There's a Fed meeting in the last week of July. What's going to happen? They're going to raise 25 basis points. They're going to go up. So what happens? What has to happen to make them stop? The market just a few months ago was predicting that not only would they stop, but they were going to cut rates before the end of the year. And I've been saying the whole time, that's not going to happen. They're not going to cut rates this year, and they're not going to stop raising rates this year. So what's got to happen to make this whole thing stop? Well, number one, there's 3 things that we have to address: wages, housing, and rents. And I think 2 out of those 3 Out of wages, rents, and housing, 2 out of those 3 have to capitulate. 2 out of those 3, housing market has to get crushed. And the reason why I don't think it's going to be the housing market necessarily is because unless they bring mortgage rates to 10%, there's a shortage of housing. People, we haven't really built enough housing since 2009. And that's a real thing. And so prices are staying elevated way longer than what you would think they would. And so 2 out of those 3 things are going to have to capitulate. And I think it's going to be rents and wages. That's where I think we're going to get unemployment. The Fed wants unemployment into probably around 4.5% or thereabouts, plus or minus. And that would loosen up wages a little bit. Excuse me. And I think rents are going to drop. And I think the Fed is going to be higher on rates for longer. And we're going to need to see some negatives, not just flat, because, this is a little bit deceiving. And all administrations play these word games. I think this one is particularly adept at it, but they all do it. Republicans do it, Democrats do it. They say, well, yeah, inflation's flat year over year. Yeah, it's flat at 5%. So if you're not getting a 5% raise every year, you're losing money. So we need to see negatives. We need to see year over year negatives. We haven't seen that yet. We're not going to see that yet. And so those are the things that need to happen for the Fed to stop. Now, what does that mean for us right now? Is it actionable? It is actionable in this sense. Rates, I looked at rates this morning, short-term rates, a year or less, 2 years or less, they're in the 5.3s. You can get 5% for 30 days. You don't really get 5%, but they quote it as if it were for a year. You only get the interest for the days that you're in there. So you're not getting a true 5%, but it's the equivalent of the annual yield. It's a little convoluted, I know. Bonds are a little funky. Most people don't generally own individual bonds, but we generally don't own bond funds, so we own individual bonds. You could buy a bond for 30 days. I would probably time it more likely to either the last couple of days of July or the first week of August, because I think you can get better rates because I think the Fed's going up. So that's the actionable intelligence on that right now. So a couple of listener questions that I want to go over. Actually, there's 3. I watched this video and the guy in the video says, we're going to talk about 3 things today. And he holds up 4 fingers. And I'm like, should somebody tell him that he's got 4 fingers up? Or maybe one of his fingers is paralyzed. I don't know. The first one, I like this because this is something that we deal with all the time. The difference between long-term and short-term capital gains. So in a long-term capital gain, you get taxed at 20%. And you got to hold an investment for a year and a day. So 1 year and 1 day you could sell it. You get a long-term capital gain. Whereas if it's a short-term capital gain, under a year, it's taxed at your income tax rate. So let's say you pay 35% in income taxes and you want to sell something, and if you wait 3 days, it'll be a long-term capital gain. You could save almost 50% in taxes if you wait 3 days. So you want to expose yourself, to as many long-term capital gains as you can. That's why you hold things for a year and a day at least. That's why long-term investing makes sense in a lot of areas, because the taxes are so much lower. One of the things that you get when you buy individual stocks and bonds is you get to control your taxation a lot more. And I really like that. I'm not generally a control freak, except for the things that I can control. I want to control them. So if I can control your tax rate to be lower, man, I'd really love to do that. And you would love me to do that. So we try to get long-term capital gains. So if you're like a week away from a long-term capital gain on something, and it's fairly significant, you're going to want to wait that extra week and a little time. That's the main difference between long-term and short-term capital gains. One's a year and a day or more, and one is a year less or less. And there's a huge difference in taxation. Excuse me. I have this little cough I got a sinus infection when I was in Brazil. I thought I came back unscathed. I didn't. I apologize. If it's annoying to you, you can't imagine how annoying it is to me. The next question, what are my favorite? I get this question a lot, and I don't avoid answering it, but it changes. And so right now, one of my favorite areas to invest in, it'd be hard not to like tech. The biggest tech companies, Amazon, Apple, Meta, Microsoft, these big companies, Palantir, and NVIDIA, they've all been great investments. Really, the S&P 500, the top 10 companies have owned the index, and they're mainly tech companies, and I do like them. And AI does open up a lot of opportunities for them to take people off the desk and use, for instance, in our industry, in money management, AI, artificial intelligence, is primarily the number one stopgap for catching money launderers right now. It's not people. It's AI identifies the people that we think might be laundering, and then a person goes in and double checks. But that first filter isn't a person. It's all artificial intelligence. So I do like tech. I like some manufacturing, especially if they're big and they're global. If they're big and they're global, but their business is mainly U.S., so maybe they're less than half outside the U.S., I like them even more, because I think we're the cleanest dirty shirt in the laundry right now. And Europe is in a bad way. Europe has never really recovered from 2008, and their austerity did hurt them, and it really dragged out their recovery. And because they're socialists, they don't really grow like we grow. And so I like the United States. I've always loved the United States. You know that. But I love the United States even more right now because it's the best place to invest. So a lot of people, especially these managers that have global funds, they have to talk their book. I don't have to talk my book. I can invest anywhere I want. So I like that. I like leisure too, because people are traveling a lot. I was flying last night. I got home late. Airports are packed. Cruise ships are packed. Hotels are packed. It's hard to get a room in places. Disney is packed. I don't really love Disney stock, but it's packed. There's a lot of great places to go in leisure. I love banks too, because net interest margin goes up as interest rates go up. The kind of banks are going to be in a sweet spot here. And the bigger the bank, the more I like it, because they don't suffer from the banking crisis that the Fed is creating by raising rates. So I like big banks. I cannot lie. And I love bonds, especially short-term bonds, 2 years and less. Now, I'm not buying a lot of 2-year bonds. I have bought a couple of 1-year bonds, but I need the yield curve to normalize. So that means the longer you have a bond, the more money you make. When the yield curve normalizes, I will go longer on bonds, and I think we're going to get some really sweetheart deals on rates and bonds where you could take some risk out of your portfolio, take it away from equities, go in the bond market, and still get a good yield. So, if you're in retirement and we're providing 5.5% income, and I can get bonds at 6.5%, which I think we will get at some point in the near future, I got to look at it. I have to do it. It's incumbent on me to do that. So, bonds, short term, one of my favorite things right now. You're never going to get rich owning bonds, but you could take some risk out and still be invested. So your money doesn't have to all be in stocks, and it doesn't have to all be in bonds. We could do a mix. It's called modern portfolio theory. Some of it does work. I tend to be a little bit more dynamic than modern portfolio theory, but that's how we do it here. You could always call us if you want to use us. If you have a question, if you just called up and had a question, there's no fee. We're not charging you. We'll talk to you. We'll answer your question if we can. If we can't, we'll point you in the right direction. The last question is, are we doing another workshop this year? And the answer is, yeah, definitely maybe. I'm thinking the fall, when people are traveling right now in the summer, maybe come back in September, things settle down, people get back into their routine. I'll admit to you this. I like meeting the people at the workshops. I don't really love doing workshops, but I like meeting who's listening and watching. I really do enjoy that because I get to meet the people that find this valuable. And so I probably will do another one, and I'll announce it on the radio, and I'll announce it here, and you can make a reservation. And we charge a nominal fee, like $10, $15 per person. And we donate all that to charity. I don't take any of that. I just want you to have skin in the game so you'll show up. It's that simple. And people will drive through a snowstorm with half of their leg chopped off to not waste $15. I've seen this before. And I want to give some money away. So it's a good thing for everybody. And we'll sit there until all of your questions are answered. I love that. I love doing it. I kind of love doing it. I kind of don't like doing it, but I think I am going to do it. Definitely, maybe. So I'll keep you informed. I am David Szafranski, a real American, a true red-blooded patriot, and the voice you can trust.